Welcome to the IFL Retirement and Insurance Services IUL presentation. It's really useful to take a quick look at the history of retirement savings in the U.S. to understand how we got to where we find ourselves today. From the turn of the last century until the crash of '29, people saved for their own retirement, much like most of us do today. After the stock market crash and bank failures, most Americans' life savings got wiped out. However, people who were fortunate enough to have cash value life insurance continued to receive income because none of the policies failed. We learned the hard way that Americans need a more secure way to save for retirement and ensure their ability to maintain their standard of living after their working years. So the Social Security Act was passed. Employee lifetime pensions became the norm. And of course, people continued to secure retirement income with cash value life insurance because it never failed to perform through the entire Great Depression. Even pension managers turned to the insurance industry to create lifetime streams of income for employees. After the crash of '29 and the Great Depression, virtually no one risked their retirement savings in the stock market. Imagine if in 1939 Wall Street began telling people, "We've got a terrific idea. Take all of the money you're saving that's supposed to last you the rest of your life and put it in the stock market." How many people would have thought that was a good idea? Probably no one. Cash value life insurance had been the cornerstone of many families' financial security from 1900 all the way up until the early 1980s when the 401k was first introduced. Then, that percentage began to slide. It seems that by 1980, we were ready to forget the lessons of the Great Depression. Why did this happen? In 1978, the 401k was invented as a way for corporate executives to postpone the tax liability of their bonuses. In 1981, under corporate prodding, the IRS ruled that the 401k could be made available to regular employees. Corporations realized they could save about half of what they were paying for lifetime employee pensions if they could convince their employees that they would be better off saving for their own retirement with a 401k. This was an opportunity for average workers to defer their income taxes, just like rich executives. Must be great, right? Soon, millions of Americans were replacing their guaranteed lifetime pensions with 401ks. Wall Street saw an opportunity that was too large to ignore. They began marketing to people to put their 401k savings into stocks and mutual funds. The great bull market in stocks began and didn't stop until the year 2000, when 65% of the New York Stock Exchange was retirement money. There are two main problems with typical retirement plans as a means of primary retirement savings. First, the 401k was designed as an executive tax shelter, not as a way to create income streams that can maintain your standard of living for life. According to the Employee Benefit Research Institute in Washington, D.C., the average 401k will run out of money 7 to 8 years into retirement. Second, just as we learned in the crash of 1929 and the Great Depression, exposing your primary savings for retirement to the stock market can be very, very risky. According to the article, Retiring Boomers Find 401k Plans Fall Short that appeared in the Wall Street Journal in February of 2011, the median household headed by a person aged 60 to 62 with a 401k account has less than 25% of what they need to maintain their standard of living in retirement. And according to the United States Government Accountability Office, the risk that retirees will outlive their assets is a growing challenge. So what do we do now that this is where we find ourselves? Well, as we often do, more and more people are coming full circle. They're turning back to the insurance industry in an effort to create lifetime streams of income. Many retirees are converting their 401k accounts and IRAs into income streams from annuities to ensure that they don't run out of money during their lifetime. As for saving for retirement, more and more Americans are turning to indexed universal life insurance, or IULs. You're probably asking yourself, what exactly is indexed universal life insurance? Well, first and foremost, it's life insurance, which protects your loved ones against the loss of income during your working years and leaves a tax-free death benefit to whomever you choose when you die. But IULs are much, much more than just life insurance. They are cash value life insurance, and not just any old run-of-the-mill cash value life insurance. As I heard someone say once, it's not your grandfather's life insurance. IULs were designed by financial experts with the primary goal of offering people such as yourself the potential to create tax-free income streams that can last until you're 120 years old, as long as they're structured and funded within IRS Code 7702 and 72E guidelines. And just as importantly, they're designed to guarantee you never lose a dime in the stock market because they don't expose you to direct market risk. An IUL is not just any old cash value life insurance because it's designed specifically to allow for the greatest possible growth and the greatest possible cash distribution once you start accessing money from your account in retirement. With an IUL, you can choose to max fund the cash value portion of your policy, which means as little as possible goes toward life insurance and as much as possible goes toward cash accumulation. With IULs, the cash portion of your policy grows as efficiently as possible because neither your principal nor your locked gains ever suffer market losses. Your gains are capped up to a certain percentage depending on the IUL you choose and locked into your account, usually on an annual basis. What really sets IULs apart and allows them to offer the potential to create income streams that last so long is the fact that when you access money from your IUL, you are not actually taking money out of your account. You are instead borrowing money against your account. This means that your account can actually continue to grow, even though you are realizing income from it. And of course, one of the greatest things about an IUL is that as long as it's set up and maintained within IRS guidelines, the income you receive from an IUL is tax-free. So what does an IUL have to offer that you can't find with a typical retirement plan? There are a number of great features and benefits of IULs that are really critical to creating retirement income you can count on. The first is protection for you and your loved ones. According to a study from the Life Insurance and Marketing Research Association, 7 out of 10 households with children would have financial stress within several months if the primary breadwinner died. More than 40% of Americans say they don't have life insurance because of more immediate financial concerns, such as saving for retirement. Well, the good news is that with an IUL, you do both. You protect your family against loss of income, and you save for your retirement future. The next thing an IUL offers is safety, incredible safety. In fact, so much safety that you are guaranteed by law to never lose a penny of your money due to stock market losses. How do they do this? Here's the simple explanation. Most of the cash portion of your IUL policy is invested in bonds. The money earned from those bonds is then used to purchase options in whichever market you choose from available IULs. In the example we see here, the options purchased are for the S&P 500 index, so your money is never directly invested in the market. It is tied to the market through the purchase of options. In years when the S&P 500 goes up, the value of the options go up, which means the value of your IUL cash account goes up to a certain cap, depending on the IUL you choose. In years when the market goes down, the options expire worthless and your IUL doesn't suffer any market losses. This is an ingenious way to enable you to participate in market gains in the years when the market goes up, yet never lose a penny to the stock market in years when it goes down, no matter how far it goes down. A lot of people think the only big stock market declines were the crash of '29, Black Monday of 1987, and of course the crash of 2008. But in fact, since 1900, the market has suffered an average loss of 47% on average every 11 years. This can create an exceptionally challenging situation when it comes to saving for retirement, because as you can see here, it can take years or even decades to recover and get back to break even when the market takes a hit that big. With an IUL, you never have to worry about market drops again. Another great safety feature of working specifically with IFL when choosing and creating your IUL is that we work with only the top-rated carriers in the insurance industry. Every carrier we represent is A-rated, in business for over 100 years and has billions, in some cases hundreds of billions of dollars in assets. This is what sets us apart and ensures that our clients can rest easy, that their retirement future is safe and secure. Effective and efficient growth of your savings is obviously of paramount importance in securing a comfortable retirement. One of the things that has become increasingly publicized in the past few years is that many of the top experts in the financial industry advocate investing in index funds to maximize the growth potential of your savings. Peter Lynch, the legendary fund manager of Fidelity Magellan, is quoted as saying, "The statistical evidence proving that stock index funds outperform between 80 to 90% of actively managed equity funds is so overwhelming that it takes enormously expensive advertising campaigns to obscure the truth from investors." And Warren Buffett says, "Most investors, both institutional and individual, will find that the best way to own common stocks is through an index fund. Those following this path are sure to beat the net results delivered by the great majority of investment professionals." Besides tying your gains to an index, IULs go 2 steps further to maximize the growth potential of your savings. They have the zero market loss guarantee, and once your gains are locked in, the zero market loss guarantee is now reset at this higher level. This means both your principal and your locked gains are always protected against market losses, which means efficient growth for your savings. With an IUL, you don't have to regain losses after the market takes a hit. Your account merely starts growing again once the market has an up year. Another challenge to growth that many investors, in fact most investors, are unaware of is the fact that average annual investor returns are much lower than the average returns of the stock market itself. In fact, according to U.S. Senate testimony by John C. Bogle, founder and former CEO of the Vanguard Group mutual funds, even though the average annual return of the S&P 500 from 1984 to 2002 was 12.2%, and the average annual return for mutual funds was 9.3%, the return of the average investor during that time was only 2.6%, because they invested their money not only at the wrong time, but in the wrong funds. In other words, the average investor typically buys high and sells low, which is easy for all of us to do. It's only natural to want to save what you have left when you lose 40 to 50% or even 60% of your savings in the stock market. And it's also natural to then want to participate in gains once you've seen the market go up 10 or 20% or even higher. With an IUL, you don't have the problem of trying to figure out when you get in and out of the market. No more guesswork, which even the experts find next to impossible. The other reason for low investor returns that many people are unaware of is mutual fund fees. According to Forbes, the real cost of owning a mutual fund is an average of 3.17% of market gains. This has an enormous impact on the growth of your savings over the course of a lifetime of saving for retirement. The article, The Real Cost of Owning a Mutual Fund, which appeared in Forbes in March of 2011, says that whereas most investors believe the only mutual fund fee they pay is the expense ratio, which averages 0.90%. In fact, the average fund also has transaction costs of 1.44%. In addition, there is also the cost of mutual fund managers not being fully invested in the market, known as cash drag, which averages 0.83%. The combined total of these costs is 3.17% annually. On top of mutual fund fees are, of course, 401k management fees. Many people actually believe that there are no 401k fees for managing their accounts, or that their employer pays the 401k fees. Unfortunately, neither is true. The reason many people may believe this is that up until this year, management fees did not have to be reported on 401k statements. Management fees range from as little as 0.5% to as high as 5%, but according to the Investment Company Institute, the industry average for 401k fees is 1.5%. Some people considering an IUL are concerned that the market gain cap will have a negative impact on the growth of their savings. Let's take a look at it to find out if that's true. I guess that's why Warren Buffett says the first rule of investing is never lose money, and the second rule of investing is never forget the first rule. With an IUL, you never lose money to market losses. And after looking at that S&P calculator, anyone can see why this is so important for the growth of your savings. Now it's time to compare your IUL illustration to what you could reasonably consider possible with a typical retirement account plan, such as a 401k. It is absolutely vital to try to create an income stream that will last until you die, because none of us knows how long we're going to live. Women who are 65 years old have a 53% chance of living to 85 and a 32% chance of living to 90. Men who are 65 years old have a 41% chance of living to 85 and a 20% chance of living to 90. Unlike 401ks, which were designed as a tax shelter, IULs were designed to offer the potential to create tax-free income that can last a lifetime. Here are the features that help them to achieve that potential. Zero market loss guarantee with a lock and reset feature so you protect your principal and your gains against stock market losses, which we've seen leads to more efficient growth of your money. Efficient growth leads to better income. The money you access from your IUL is borrowed against your account, not taken from your account, so your account has the ability to continue growing even as you're accessing income during retirement. It's just like your home. Its value can continue to go up even though you take loans against it. And of course, because a properly funded and structured IUL can create tax-free income, all of your income is spendable. Let's compare the income potential of your IUL illustration to the income potential of a typical retirement plan. We're moving on to the potential tax advantages of saving for retirement with an IUL. Let's start by reading a portion of an article that appeared in the Wall Street Journal in October of 2010. When Congress created an income tax in 1913, it exempted life insurance, in large part because it was seen as providing a safety net. For decades, whole life with its tax-free investment component was the cornerstone of many families' security. The percentage of families buying such policies began sliding in the 1980s with the proliferation of other savings options, such as mutual funds and 401k accounts. The percentage of American families buying cash value life insurance policies may have begun sliding after the 401k was invented, but the wealthy did not stop buying them. The article says that 22% of assets accumulated in tax-free cash value life insurance policies in 2007 were held by the wealthiest 1% of Americans. The reason? It gives the affluent tax advantages far beyond those available to middle-income people through a 401k or an IRA. It allows some people to get nearly unlimited tax-free savings. Middle-class people have been getting a smaller portion of the overall tax benefits, in part because they tend to hold less costly term insurance, which provides coverage for a designated period and doesn't involve a tax-advantaged investment account. With an IUL, everyone receives the same tax advantages, whether you're wealthy or not. With a tax-deferred retirement plan like a 401k, you defer a portion of your income tax on your current income. Your retirement account grows tax-deferred, but then you pay income tax on the money you draw out of your 401k account in retirement. With an IUL, you pay income tax with no deferred taxes now. Just like a 401k, you defer taxes on growth in your cash account, but then you pay no income tax on the money you access in retirement. Why do the wealthy like tax-free cash value life insurance? Let's take a look at the difference it means to the tax implications on your retirement income and find out. Many people wonder how income can be tax-free, but it's really very simple. The income you access from your IUL is taken as a loan against your account, not money actually taken from your account. And of course, loans are not a taxable event. Therefore, as long as you stay within IRS guidelines, there are no tax consequences. So the potential tax advantages of an IUL that is structured and funded within IRS guidelines are: it can provide a tax-free inheritance to your heirs. It offers the potential to create a tax-free income stream that can last until you're 120 years old. It eliminates exposure to future tax increases, so if you're concerned that the ever-expanding federal deficit will result in higher tax rates, you can stop worrying once and for all. And with an IUL, you don't add to the taxation of your Social Security benefits. IULs can also result in lower costs and fees to your retirement savings, contrary to the opinions of many of today's most popular financial gurus, who can often be heard telling people to buy term insurance and invest the rest in the stock market. Well, many people are tired of the stock market roller coaster and would like to get off, but have been afraid to, because they thought the only alternative was to save for retirement in CDs and money markets. With rates so low, they will be guaranteed to run out of money in retirement. With an IUL, there is now a viable alternative for anyone who wants to get off the stock market roller coaster. The pundits who tell you to buy term and invest the rest forget to tell you that term insurance is the most expensive type of life insurance, because 99% of term insurance never pays a death benefit. This means that only 1% of the money spent on term life insurance ever realizes a return. People who say the cost of cash value life insurance is too high know little or nothing about IULs. When pressed, most financial gurus will admit that when they say that cash value life insurance is too expensive, what they really mean is that the surrender fees associated with the cash value life insurance are too high. There are several problems with this argument. First of all, a 401k can cost up to 50% or more to liquidate until you are 59.5 years old, depending on your tax bracket and the tax rates of the state you live in. Secondly, even after you no longer have the 10% penalty when you reach 59.5, you're going to be taxed on your gains and the taxes you deferred if you liquidate your account, which could still add up to almost half your gains. With an IUL, surrender fees decrease each year and in most cases are eliminated entirely within 5 to 15 years. But an even more important fact is that retirement accounts are meant to last your entire life. They aren't intended to be surrendered. So calling cash value life insurance too expensive due to high surrender fees is simply misleading. Let's compare the fees on your IUL illustration to the fees you can expect with a typical retirement plan. The last advantage of IULs we're going to mention is their flexibility. With an IUL, you can access your money at any age without realizing penalties, excess fees, or tax implications. There are no contribution limits and no restrictions based on the amount of your income. There are also no required distributions once you reach a certain age. In addition, some states and policies allow you to receive an early death benefit for assisted living, or if you have a terminal or chronic illness. We like to go over a few of the most common questions and comments we hear about IULs. Typically the first, and without question the most common comment we hear at IFL is, "It sounds too good to be true." All you really have to do to realize that IULs are not too good to be true is remember that unlike 401ks, IULs were specifically designed and created to offer the possibility to create tax-free income streams that can last until you're 120 years old. The zero market loss guarantee and lock and reset feature result in safety and tremendous account growth potential. Loans against your account rather than withdrawals from your account mean your account has the potential to keep growing even as you realize income from it during retirement. And tax-free income results in 100% of your retirement income being spendable. IULs were simply smartly designed. That's how they perform so well. The next thing we hear most often is, why doesn't everyone know about IULs already? First of all, they were created in the 1990s when most people in the country thought they were going to retire rich from investing in tech stocks. Second of all, a lot of people have heard of them and more people are hearing about them and starting one every day. Since 2006, the number of people with IULs has been growing about 38% a year, and the number continues to grow. And of course, they're no secret to the wealthy. Anyone who has access to financial advisors who stay current on ways to create tax-free income has known about IULs for years. People who still get employee matching funds are sometimes concerned that they'll be giving up free money if they stop saving for retirement through their company 401k plan. But as we all know, there's no such thing as truly free money. The cost in this case is that you're still exposed to stock market risk, you still run the risk of running out of money in retirement, and you're going to be taxed on your income in retirement. As for the consequences of giving up tax-deferred income in exchange for tax-free income, we've already seen that it's actually not a consequence but an advantage, a potentially huge advantage. Some people argue that you can get tax-free income with a Roth IRA, and you're right, you can. But you won't get life insurance, no contribution limits, no restrictions due to income limits, elimination of stock market risk, reduced fees, access to your money at any age with no penalties, and the potential to create an income stream that can last until you're 120 years old. We hear, of course, that the cost of insurance is too high. But we've already covered the truth about that, and we've also already covered the misconception that the fees are too high. The bottom line is this. If someone tells you that you should buy term and invest the rest, or not get an IUL because they think the fees are too high, even though they know little or nothing about IULs, you should really insist that they show you a better way to save for your retirement, a way with real numbers and real facts and figures, a way with risk you're comfortable with, a way without the constant roller coaster stock market ride if you're tired of it. If they can't show you a better way, then you really need to use your own judgment. Use your own common sense to determine what course of action is best for your retirement, based on facts, not on tired, worn-out slogans from financial gurus who are paid by Wall Street advertisers to sell their services. So how do you get started? Actually, it really couldn't be easier. All you have to do is apply for your policy to find out if you're accepted for life insurance. If you're approved, that's it. You start saving with your IUL. Take back control of your retirement future today.